Andrew Holland is joining us right now. He's CEO at Ambit Investment Advisors. Andrew, good morning. Good to have you with us here. Thanks very much. Would you say the prospects for the GST to go through are looking a bit more bright now?
Yeah, I mean, they do, and I think we're all kind of keeping our fingers crossed that it does happen, because we need some good news. I mean, you know, it's easy to focus on the negatives, and everyone seems to be doing so, or have been doing so in the last few weeks. So, you know, if the GST gets through, I think it's more of a sentiment positive, you know, for us all, maybe to get back to focusing on some of the better things rather than the negatives. Obviously, in terms of the details, we'd have to wait and see that. But, you know, Prashant, I've never been a great believer that GST was going to add so much to GDP growth so quickly. So I think it's more of a reform positive, which markets have been hoping for, foreign investors have been looking forward to. So I think that will just keep the momentum going for India in terms of foreign portfolio flows going forward. But also I think give us all a bit of a sigh of relief that things are moving ahead. So let's hope the all parties can get together on this, because you know, the more we stick around on policies which are good for the country, you know, the opportunity of taking incremental foreign direct investment away from places like China keeps moving further back. So it'd be good news for the whole country, I think.
You know, but as some have pointed out, I think that kind of ties in with what you've said for a while, that GST won't add whatever numbers are put out, this percentage to GDP, etc. That if you keep alcohol, real estate, property, and a couple other things out of the ambit of GST, tobacco, etc., you know, the mathematics, just purely mathematics wise, it's actually not going to do very much for you in terms of the boost to GDP. And I had it from Mr. Satya Podar, who's a policy advisor at E&Y, talk about this in some detail last week. So, but yes, I mean, sentimentally, you know, this reforms are going on, that kind of thing. It adds to that overall sense, right? But I guess once it is done, if it is indeed true that it won't add very much, won't investors look through it? Andrew?
No, but yeah, so, you know, I said I don't think anyone, well, first of all, you know, would they be able to make that deadline of April 2016? That's also looking a bit fraught in terms of the timeline. So, you know, it's probably going to get pushed back anyway. But what I think it does, Prashant, is that, you know, listen, we know it's not going to, and it was never going to, just kind of shoot the economy higher. So I think no one was expecting that. It's all part of the reform program, but maybe 1 to 2 years down the road, as it continues to be implemented, it will have a beneficial impact on the economy. But, you know, where we're thinking that the economy is starting to pick up, it's obviously the government is spending a lot of money now on the roads and infrastructure, and also the railways. And railways, probably in the expenditure there, is probably going to add more to GDP than GST would, even in everyone's most optimistic views. So I think we're looking at GST as you know, in the wrong way if we think that's going to propel the economy. I think what the government's doing now is helping to move the economy forward, and as that multiplier effect starts to come through, then obviously it'll have a beneficial impact across many different industries. And we're starting to see that, we're starting to hear that, although corporates themselves are very tentative in getting too excited. They still have a patchy order book, but it is picking up for them, but they don't want to declare victory yet, so they're being a little bit more cautious.
Andrew, I'll get to the broader market view in a little later today for a change. Want your thoughts on this, not a trend, but a couple of state governments now essentially banning alcohol sales in their respective states. Bihar is the latest to join the list. How do you account for something like this? How do you kind of build, or rather prepare for something like this as an investor? Is there any way to do it? I mean, of course, you can decide not to own the own the stocks in that space, but again, you've got to take a call that this is going to grow and more states will do it.
Yeah, I haven't, first of all, quite understood why, because it's obviously, from a revenue viewpoint, it's going to be a big hit on Bihar. So, maybe there's some wiggle room before now on April the 1st for that to change slightly. Not quite sure, but I would have thought this, for other states, they'd have to look at their own kind of balance sheets and whether they can afford to do that. Excuse me, going forward. So you could take the cautious stance of saying, okay, well, other states may do it, and therefore I don't need to own the stocks which are involved there. But I think that would be a pretty radical move to do, and we certainly wouldn't be doing that or thinking like that at the moment, given that the states themselves will want to continue to attract investments and into the respective states themselves. So I don't know if it's a one-off, but I'm not picking up that it's going to be widespread. So, and I think share prices of the companies involved would be a lot lower if that was the expectation. And the market always tells you what you really need to know, and I don't think the market's telling me that this is going to be going beyond Bihar at the moment.
Yeah, after this, there was some chatter about if Maharashtra will follow Bihar next, and if Maharashtra did follow, then that would be a real big one. But I think we already have some comments and statements from the ministers here saying that Maharashtra is not considering such a move. It can't replace the revenue lost if they actually decided to do it. So that is that. As far as
but I think also it would kill the whole. It'd kill the whole wine industry, which they've been trying to build in and around Nasik as well. So I find that very strange if they were to do that.
Yeah. There's one is the GST, the other is the bankruptcy bill, right? Bankruptcy reform, which is again before the parliament. Have you looked at it? I mean, spoken to people in the business and how this could change things? Andrew, for banks and for corporates as well, especially the troubled banks and troubled corporates, the distressed ones, yes.
So, as usual, when you do speak to people, they surrounded in how it's going to be difficult to implement, the courts need to change, and so forth and so on. So it's like, it's a great it's a great move, but it can never kind of work, or it's going to take too long, or whatever. But I think what it does is a couple of things. Is that maybe going forward, as and when it's implemented, you have to look at the details then, because it's still draft. So you need to understand how things change from the draft to the final proposal. But what it would do, obviously, would have companies thinking about whether they wanted to be declared bankrupt going forward. And I think it's not a nice word to have in front of your company's name or you being the promoter for it. So I think that would be helpful in terms of companies thinking a little bit more before taking on debt. But even before that, Prashant, what I'm hearing, which is a very big positive for the banking industry, is that with some of the indebted companies, and that's why you're seeing a lot of asset sales at the moment. I think the banks are going, well, I'm actually hearing that the banks are going in there and saying, listen, unless you do this, we're going to take some of your shareholding away. And obviously for a lot of promoters, that's not what they want. And in fact, one of the large indebted companies, I believe the bank has just appointed themselves merchant banks, to sell off one of the businesses without even really speaking with the management. So that's the kind of action the banks are taking, which is good news. So I think the bankruptcy law will be a game changer, but maybe it's a game changer in terms of how corporates actually act and their governance going forward. In terms of would it be a process which would be quick and easy through the courts? We'll have to wait and see. But I'd rather be more positive about it than negative. And it's obviously always easy to be negative about how things are move too slowly in India. But this would be again a sentiment change positively for how we think about banks going forward. And anyway, we're coming towards the problems in NPAs, to my mind, in the next 6 months. So I think anything that gets through on the bankruptcy law would be seen very positive by the markets. Finally, I think at this stage everyone wants to focus on, is it possible, is it implementable, is it this or that? But I think the banks are already taking the actions which they need to do right this second. So it's just it's an added incentive for companies to think about how they're going to build their businesses going forward.
I think one of the things which is which is part of the bill, just one of the very lots of recommendations, is if a company defaults to a financial institution, the company can be declared insolvent. The current law is it's got to have defaulted over more than 50% of the loan value. So it kind of gives more power in the hands of financial institutions, lenders, to deal with these kind of situations. But as you said, we're no legal experts. We'll have to wait for all of it to come out and get more perspective on this, but it's definitely important. I'm just jumping topics here, Andrew. What are your thoughts on the telecom in Bharat, and especially Bharti? When you can add idea to that list, are the markets greatly underestimating the impact of potential disruption caused by RGO's entry into the business? And that's just one part. The other part is, of course, non-telecom players also launching new services, calling services, etc., enabled by TRAI's norms on termination charges and things like that. There's a fair bit of disruption going on as well.
Yeah, it's not a sector that we own, to be honest, Prashant, because of everything you're saying. It's a sector which is changing. There's a lot of obviously we've got a big player coming into the market very soon, and we'll have to see how that plays out. I think there'll be more consolidation within the industry. We've just seen a little bit of that through IDEA. But the thing about this is that you can wait and see how the dust settles before deciding which horse you want to ride again. But it's not a sector which kind of excites me. It excites me from the Reliance angle because obviously their capex towards this industry will start to come down, and their free cash flow can be used hopefully to pay us more dividends as Reliance shareholders, for example. So there's going to be positives for Reliance. I don't see those positives for the other incumbents in the telecom sector. So I can sit on the sidelines and watch it and wait and see how it plays out, rather than saying I think XYZ is going to do particularly well. I think it's a kind of a moving target at the moment, so I'll wait till it settles down before refocusing my kind of ideas or thoughts on the sector.
I mean, there is by the way, one thing I did not mention is the Vodafone IPO, which is going to hit the market not very far in the future, right? 23% market share player, and it's a big IPO. So any so-called scarcity premium which any of these frontline telecom companies may enjoy may start to, disappear as well. And anyway, business, as we discussed, isn't. It's not ideal. Lots of competition from other telecom, new players and non-telcos as well. So let's just come to what you are doing, Andrew. How is your portfolio looking now? And you're both on the long and the short side. So which side is heavier in terms of overall funds managed, Andrew?
Yeah, so we continue to be net long of the market. We think that, a few things, Prashant, and in terms of the GST, I think will be the catalyst for the markets to move higher, and then we have the Fed. Now, the consensus view is that the dollar will remain strong, but I think where it is now is kind of indicating you're going to get aggressive rate hikes throughout 2016, which I'm really not thinking that that's the case unless the US economy is really going to take off, which I'm not saying it is, but it's obviously gradually improving. So maybe that the dollar weakens actually, not significantly, but weakens against some of the emerging market currencies, which have been under pressure over the past over a year or so. Now, if that happens, and then I think we're towards the end of the commodity kind of falls. There will be some scares here and there, but I think we're getting closer to that to being at the bottom. That would be good news for emerging markets overall, and then you might see some more incremental flows into emerging markets, of which India still stands out as being one of the best markets to be. So we might start to see better flows going into the new year. Once the Fed has increased rates in December, if that's what they're going to do. So that backdrop, and then towards the budget, we could get more excitement about what's happening around India. But overall, I just feel that the ingredients are there for this economy now to start to move higher or grow quicker, and that will have a multiplier effect. I mean, we talked about the railways and infrastructure and roads where the government is spending money, but it doesn't happen overnight. It just takes some time, but I think we're getting to that inflection point now where it will start to have positive impact on the economy and also corporate earnings going forward. So we're continuing to kind of focus on who supplies India across many different sectors, and that's played out quite well for us over the past year or so. And we think India is a domestic growth story only, and that's why we're focused only on domestic stories in India.
Right. Just one point. When more than a few weeks back, I first started hearing from people that the market should actually rally after the Fed hike, right? And I thought, okay, maybe that's a bit of a non-consensus kind of view, because generally what we heard for the last many years in anticipation of a hike is, well, a hike will do this, it'll pressure emerging markets and dollar strength and all of that, right? But now, I mean, it's the post-hike reaction of a market rally around emerging markets seems to me more and more like the consensus one. So I'm kind of forced to reconsider what actually will happen after the hike, because what do you think? You think we'll still get a rally? Generally, broadly, we'll still see an up move after the hike?
Yeah, despite what you just said, I mean, emerging market currencies have continued to weaken over the past few weeks, along with commodities. So, it's not playing out in the main markets that you would look to give you that kind of expectation that there could be a rally for global markets. So it will still have to play out a little bit more, Prashant. But the positive from the rate hike in the U.S. is that the U.S. economy is seen to be improving. You've seen that from Europe as well, in terms of either the sentiment indicators or growth from even some of the periphery countries like Spain and Portugal. So things are starting to pick up there a little bit. But what I do feel that we all need is some fiscal stimulus, to push the economies maybe of Europe ahead. China in particular would need some fiscal stimulus. I think we're all used to the kind of monetary stimulus that we're having, but I think fiscal stimulus as well is probably what's needed to get us out of this deflationary problem which a lot of countries are facing, and start to see improvement in GDP growth as well. So that might be the theme for 2016, which, if it is, I think would lend itself to a lot of flows for emerging markets, because obviously they would be beneficiaries of that. But I think also when you think about the Fed and what
just to interrupt that thought. Now, the basic premise that a hike would indicate that the U.S. economy is getting better, and that's that's obviously fair enough. That's no argument with that. But I think there'll be a lot of disagreement about that, a lot of discussion around that. I mean, is the hike really motivated by considerations of the economy getting better and finding themselves in a good place to hike? Because, I mean, if you go by that, they were there a year back, right? When they met the unemployment number, the jobs number, etc. And then they kind of said, we won't look at numbers, we look at a qualitative assessment of it. So it'll also be debated whether this is because of financial market considerations, whether delaying a hike would send the wrong message, as the minutes from the last FOMC showed. And forget about that debate as well. Just take a look at the S&P, right? S&P is rallied about, what, 10% in the last 7 weeks. It's about 2% away from its all-time high. But on the S&P, the number of stocks at a 52-week high is at a 3-year low. I mean, stocks like Facebook, Netflix, Google, Amazon, I mean, that pack essentially is what is propelling it to newer highs. Otherwise, number of stocks at 52-week highs, with the market 2% away from the all-time high, is at a 3-year low. So what does it tell us? Is it telling us that people believe that the economy really is getting stronger? The market itself is not telling us that.
No, what I think there, Prashant, is slightly different than, I mean, you give me some good facts and figures, actually. So I've been trying to quickly analyze that. But, you know, what I think, you know, and the reason I'm saying that the dollar might weaken is that everyone's view is that, you know, everyone's going to be rushing towards the US. And I'm not sure that is going to be the case, because valuations in Europe, so if you're thinking that Europe's the next place that is going to, you know, start to recover, then the valuations in Europe are a lot cheaper than the US. And the US valuations are still very high against the 10-year, 15-year averages in the US. So, you know, incrementally, it's harder to get those kind of gains from the markets. But, you know, if I look then towards emerging markets, and I see that, you know, Russia, you know, and Brazil and China, you know, and Korea have all recovered quite sharply, and our market's done nothing. It's showing that people are looking at the valuations or where you can see better value in some markets for a recovery that they're expecting, both globally, but also as sentiment maybe changes towards emerging markets as you get more stable currencies and stable commodity prices. And I think that's what's happening, Prashant. So, you know, you have to look out just outside of the US and say, what else is happening? What's the picture telling you? And the picture telling you that, I mean, why should Russia, you know, be one of the best performing markets in emerging markets this year? I don't know the answer, by the way, but obviously people are saying that things are going to stabilize for the country and get better. Same for Brazil, same for Korea as China picks up, and the China market's in a bull market again. So what was all that about?
Russia,
you know, when I
by
think
the
about
way,
India,
before becoming, Russia is up some 12-13% for the year now. But Russia at one point was down some 40-50%, right? Was the worst performing market. So, I mean, the answer to that, without looking at individual reasons, etc., is essentially very simple, that you get to extremes and then the market bounces back. And by the way, I remember speaking to someone when the Russian market was down some 40-50% for the year, saying, well, maybe that's the market to look at now. So, I mean, it's kind of played out. So, it's not that surprising. Just as an aside, I mean, you know, I guess.
Okay, when you say it's not surprising, Prashant, I mean, you know, let's go back to, you know, early part of the year. So you had, you know, Brazil, Russia, Korea, all, you know, in terms of markets collapsing. Then you had the China market collapse, and basically our markets followed, you know, not to the big extent that you saw in other markets, but you know, we never recovered that much, right? So it goes back to the valuations, and the valuations in India's index are around the 10-15-year averages, right, of 14-15 times 1 year forward, right? But your broader market is where you're getting all the value, and the broader market is where you're playing the domestic growth story of India.
Got that. I mean, I think where Russia got to, I think we got to sometime late in 2013, right? October 2013 with the currency at 68, etc. Of course, I mean, Russia and Brazil, etc. sold off a lot more. But, I mean, similar type of thing happened here as well. The market bounced very significantly off those lows for many months to come. Thanks very much, Andrew. Great speaking with you. Appreciate your time here.
Pleasure.
And good conversation, as always.